All right. Here we are again. It's great to see everybody out. We got a good little crowd here. Glad everybody can make it. We had a great class last night in the university, and I was appreciative of everyone who came and hung out with us and spent a little time to learn a little bit more about how we can try and make a little bit of money in these crazy stock markets. All right. So last night we focused very much on the sandbox style of trading, right? The sandbox. So let me bring the sandbox up here real quick, just to remind us that the financial market has three basic structures that we want to work within. Now, there's more than this. These are just the three that I want to talk about primarily, and primarily most people trade in. Now, most people trade, remember, on level one. Now, level one, of course, is just capital appreciation. Buy low, sell high. And we talked about that last night, and we introduced you to some stocks that were really great for that. And here's that slide right here. So capital gains, this is how you just buy low, sell high. And these are some of the most popular growth stocks in the entire stock market. This list here is called the Magnificent Seven, and this list here is called the blue chips. All right. So blue chips are great big companies, very solid foundational, organizations that you can invest in. And then the Magnificent Seven, they're the big tech stocks. So they're the ones that have huge growth. So what I want to do today in the lab is I want to go through and I want to open these up in our trading platform and just look at them. And we'll just talk about them a little bit, because I do want to introduce you to some concepts of how to pick the right stock at the right time, because we're going to take the same concept of how to pick the right stock at the right time. We're going to apply it to our yield max and our high yield funds. All right. So these are high growth funds, but we use the same strategy to pick the high yield funds as we do the high growth funds. So we'll just talk a little bit about that. I'm not going to go into it in great detail because, shameless plug, I have a class coming up called Technical Analysis. The day trading class is the technical analysis class, and we're going to go into it in much greater detail on how to pick the right stock for investing in that class. All right. So I would encourage you to run out quick before the seats are all full and they put you on the waiting list, but get into that class because it's almost full, and make sure you get signed up for that class. So let's come in, and this, I've already done the hard work of going out and putting these all into our trading platform. So this is our trading platform. This is Track and Trade. And just real quick here, I will give you a place where you can go get this if you don't have it.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right. You don't have to go download it right now because it'll probably take you the whole time that we're in class to go get it and get it installed and get it all up and running and everything. Just stay here, and then after class, you can go get it. All right. So what we're doing in here is we're taking a look at, see how we're doing. Oh, we're doing okay. So then we're coming in here and we're looking at these different stocks. Now, these are what we call the Magnificent Seven. All right. So that's Apple, Amazon. Caterpillar is not a Magnificent Seven. Let's delete it out of here. Not that it's not a good stock. It's a great stock trade. We just, it's not one of the Magnificent Seven. So Apple, Amazon, Facebook, Google. MAGS is all of them in one. So MAGS is if you want to invest in all of them at once, you can just go into MAGS. And again, that's an ETF, an exchange traded fund that has all 7 of those stocks in it. And you just buy this one stock. And you see it's trading at $67 per share right now. So if you want to buy that at $67, that would put you a little bit into each one of these. So the other ones are Meta. Oh, look at Meta tanking. That's good. It gives us an opportunity to buy Meta low. So we draw a little ruler in here. And this little ruler, we measure from low to high, and then it tells us where the buy zone is, which is right in here. All right. So when the market goes from the low to the high and then retraces half or 50%, or right down in here somewhere 38.2, 61.8. You don't have to go all in. You can buy a little bit at 31.8 because oftentimes it'll turn around and start going up there. If you buy a little there, that's okay. You can buy a little bit more at 50, and then you can buy a little bit more down here at 61.8. So that's what we do. We kind of wait for these markets to pull back against the previous run. When it pulls back, that's where we want to be buyers. Buy low, sell high, right? And this kind of comes in and tells you it's green zone, meaning that it's getting ready to buy. We're going to come in. We'll get another. This went up and made a little red zone in here as it was starting to rally again right in there. But now it's going to come down. It'll make another big green zone down in here. So we have buyers down in here. Don't feel rushed. You don't have to like, oh, no, I need to buy it right now, because as it falls like this, it'll probably – see how it generally, when it falls, makes red bars? It generally curls and goes a little sideways, and then it starts to go back up. So you got a little time. It'll probably come down, go a little sideways, and it'll start to go curl and go back up. All right, so that's how we look for these markets. That's what we want to use, these tools, to help us know when to get in and out of these markets. And we're going to use that same strategy when we get into our high yield funds as well. Now, Meta is not a high yield fund. Meta is a high growth fund. So when you get in to realize your profits, you're going to have to sell it. All right. So you can't just hang on to it forever. Otherwise, you don't get any money and you can't go spend it. It just grows. And that's cool too. Nothing wrong with that. But he just realized eventually you're going to have to sell it so that you can get the profits out. Whereas the high yield stuff, we buy it, we never sell it, and it just keeps sending us the high yield. All right. And the stock will go up and down, but they keep sending us high yield. So that's why we like them, because we don't have to ever sell them, because they just send us money anyway. All right. So then we come in here and we got Microsoft. This is the other one, Microsoft, and it's flushing back a little bit. NVIDIA is still tearing up, but it looks like, I bet you NVIDIA would get at least a couple of little red bars, probably something that looks like this. Right, probably something like that. We'll probably end up like right in here somewhere. Maybe, we don't know. But sometimes, NVIDIA likes to go a long ways, big greens. But it's had some big greens before it starts to have a little red. So it's had a lot of greens. Probably have a few reds here. All right, and then we got Tesla. Tesla's on the same thing. Tesla just had a nice little buy signal right in here. So this little line across here? That's a trend line. It's actually a mathematical trend line. We call these trend lines, all right, as markets move through different levels of support and resistance. And again, not going to go into that in great detail. Some of you are familiar with that. Those of you who are not, we'll talk about that again in the next class, about areas of support, resistance, trend lines, how we read these charts. But this is a nice little buy signal right here that we got right there. And so that's telling us, hey, it's time to get into some Tesla. Now, whether you buy Tesla itself, this is the growth version. All right. Now, remember, we have a high yield version of Tesla, which is also the pair. Remember, we're going to do pair trading. And we're going to talk about pair trading in greater detail on Wednesday. So make sure you don't miss Wednesday's class. So Wednesday's class can be very important. We're going to talk about pairs trading, which means what we do is we actually look at the underlying stock of the ETF that we're going to be trading. And I'll show you that in just a minute. But I wanted to kind of show you these nice big stocks. This is Tesla. And then, this is Walmart. Walmart is not one of the Magnificent Seven. So although a great stock, it's not one of the Magnificent Seven. So there's 1, 2, 3, 4, 5, 6, 7. I've got 8 in here. How come I got 8? Amazon, Facebook, Google, Mags, Meta, Microsoft, NVIDIA, and Tesla. That's our 7. Facebook. Oh, I got Facebook in here twice. Oh, that's not even Facebook. That's a mistake. Delete. That's not one. Okay, Meta is Facebook. All right. So these are all pulling back. That's nice for those of you who are just getting started, and it's giving you an opportunity to get in without having to buy way up here at the very top of the market, because we want to buy low, sell high, remember? But even when we're doing the yield max stuff, even when we're doing the high yield funds, we want to watch and be mindful of when we get an opportunity to get into these funds at a lower rate. So that's the Magnificent Seven. And now I'm going to go over and we're going to pull up the other list, and I'm going to bring that over here. And that's the blue chips. All right. So we got Eli Lilly, JP Morgan, Walmart. There's where Walmart was. American Express, Oracle, Wells Fargo, and Costco. So those are just a couple of the really nice big blue chips. So let's go open those up. So in track trade, I'm going to say new. I'm going to write in here. This is a new portfolio, and we're going to call it blue chips. Say okay. And now we're going to type those symbols in there. And I'll just type them real fast here. You can type them all in at once, just separated by commas. So we'll just go LLY, comma, JPM, comma, WMT, comma, AXP, comma, ORCL, comma, WFC, comma, COST, enter. And Track and Trade goes and opens up all those charts for you, downloads the data, and then displays them. So let's start with AXP, which is American Express. Now you'll notice I have a little tool on here, which is called the Donchian channel. See these lines right here? And if you come down here in the bottom right corner, you can see I have DON. So if you come in here, you'll notice that the period on DON, I have it set to 100. And the reason I have it, hold on a second, I'm losing my voice. All right, sorry about that. Okay, so on my Donchian channel, you can see that I have it set to 100. All right, so if you come into your preferences, you click that little Donchian channel down there in the bottom right corner, it comes up, you put in there 100, and I've got an offset of 2. And then I change my color so it's yellow, yellow, and green. So the green is the center point, and this is the yellow. And all this is it's just it's a cheap way, or it's a fast way of drawing this little measuring tool that I've got in here. So it does the same thing. It just does it mathematically. So see how you can draw that little tool in there? This is called the Fibonacci ruler. Don't worry about the name. It's just the guy's name that made it. Fibonacci is just a man's name. So it's just a ruler. And what it does, it tells us how far a market moved from up to the top. Oh, let's get the right tool there, Lan. Come on. There we go. Okay. So we go from low to high, and then it just counts. It just tells us how far back against itself it's moved. So see, as it comes back, it comes down 38%, comes back, that's 50%. So, and then this one here is 60%, 70%. And then as it comes down, it would go all the way back down to 100%. So that would be the retracement. Now, markets have a tendency to move in waves, right? They go up and down. So they go up, then they go down, and then they go up, and then they go down, and then they go up and they go down, and Lan keeps grabbing the wrong tool on the screen. So let me try this again. So they go up, they go down, and then they go up again, and then they go down, and then they go up again, and then they go down, right? So in that process of moving through these waves, as they come down and they start to turn around and go back up, I've got another little tool on here. This is called the blue light system, and it comes with the Bulls and Bears plugin into the software. And as it breaks like that, that's usually a good place to buy on the next rally up. Okay, so as it comes down, you can see that little blue light up there comes down. And then when it turns around and starts to break that blue light, that's usually the next run up. So you get a little bit of a break here. You can see it started to go sideways, and then it broke those blue lights, and up it went again. Now it broke them to the downside, so now it's going to probably come down for a little while, and then it turns and starts to go up, and it breaks them to the upside. And then it goes up for a little while, and it'll break those to the downside, and then it'll probably break them to the upside, and it'll just keep going through those little patterns. Now, this is a bull trend. Remember, because we're having higher highs and higher lows. Hold on a second. Still losing my voice. So we have higher highs and higher lows. So this low is higher than this low. This low is higher than this low. So that means that we got higher highs and higher lows. Now, usually, not always, but usually when a market makes 3 lows like that, and when we get 3 runs like that, we usually get a break, and then the market turns around and comes back down from there. All right. So what I like to do is I draw my Fibonacci ruler, and I go all the way to the very top of the 3rd drive. So this is what we call drive 1. This is drive 2, and this is drive 3. Now, where it's going to top out, we don't know. We're just going to watch the color coding, and we're going to watch these breaking these little blue lights. And then when the market comes down, oftentimes what it'll do is it'll go down, it'll come back up, and then it'll come down again, and that's where it'll come back down into these pull down zones, in these pullback zones down in here. So this will give us an opportunity Yeah, it's way up there right now. So it'll give us an opportunity to start buying down low as it comes back down through these trends. So you can start to buy here, you can buy here, you can buy in here. You don't all go in. You don't just slide all of your chips in at once. You buy a little bit at a time as it comes down. That's called dollar cost averaging. So you buy a little bit down in here, and as it turns around, and that'll build your position so you can have a nice position down in here so that when it does turn around and start to go back up, like out in here, then you'd have a nice big position and you can ride it back up. All right. So that's kind of just a little technical analysis, kind of what we're looking for. Doesn't mean it has to drop all the way down in here. You know, the market's really on a tear. This is American Express. They've been doing really well. But, you know, we would expect maybe a little bit of a pullback in here somewhere and give us a little, you know, a little pattern like this. Let me get rid of some of these and I'll show you another little pattern that we can look at. So you were in the previous class, we talked about some of these little patterns. So this would be a little head and shoulders pattern, right? So we would look for something like that to come in here and then maybe up like this, and then this is where we'd get the next down. So that would be your little head and shoulders formation. We talked about that one, remember, in our last class. So that would be that little pattern that we'd be looking for in there. Maybe we can see this thing down in here and give us an opportunity to buy some down here so that next time it goes up, we got some lower than it. Buying it up here might be kind of tough because, you know, especially if it goes down for the next couple months, then we might have a hard time getting, you know, making that make money. It would just show that it's losing money the whole time until it turns and you have to wait for 6 months for it to come back to start making money again. So it's better to kind of buy on the dips. That's why we can say buy the dips, buy these low points down in here. That's why this comes down and goes green for you, tells you when to buy these little dips, right? So right now it's red, meaning don't buy. That's a warning signal down here saying, that's really high. Don't buy up in there. Wait till I got a little green. I'll give you a little green indicator down here saying that maybe you could buy a little bit down in there. So then it'll probably go back up, give you another little red one right up in here as it comes up. Then it'll come down here and it'll give you a whole bunch more greens back in or out in here. So you can see where the greens are. And that's usually the best place to buy into these markets when there's lots of greens. Okay, this is called the chalk and money flow. Now when it comes out of the box, it doesn't come out of the box like this. I have to set it up the way I want it. So you can see my settings on the CMF indicator. That's this indicator down here, and that's kind of telling you got green, red. Its CMF period is 12. Show gradient colors. It's just kind of fun. I don't show the arrow, so I no display and then reverse the formula. You got to reverse the formula or else it'll put green up on top. You don't want to be green up on top because that'd be telling you to buy high. You don't want to do that. All right. The other indicator that we like to use in here is called the MACD. All right. So MACD, and I'm going to remove the CMF. And the MACD has color coding just like the CMF. It's just a little bit different. All right. See how it comes down and it dips, and then down in here, it changes from red to green down in the low zone. So see how it correlates up there? So it goes from red to green. That's a good place to buy some. And then as it's up in here, see, it's even though it's up high, this one tells you, you know, it's going into a little red zone. When it goes from red to green again, you might want to buy some up there. So right in there. But that's still high. It's not buying low. So this one you can see is way high, way up in here. It's just got a little bit of a color code change that tells you when markets are coming down. See how it's gone red up here? Remember, red means that the price bars are closing lower than they're opening. So this is downtrend, uptrend. Green bars means up, red means down, of course. And so this corresponds down here, this moving average, convergence, divergence, called the MACD. It kind of helps you understand where the buy zones are. So the buy zones are really down in here. So we don't have a lot of buy zones. Even in this one here, you can see that it was here and it didn't really come down into the lower region. So if it comes all the way back in here, we'll probably get this little MACD will probably come way down in here, and that would be a good buy zone in there. Each of these little red pullbacks are just other locations that you can put a little bit in or add a little bit in right in here as you build your position on some of these markets. But remember, markets don't always go straight up. They don't go up. They go up, and then they come down. They go up, they come down. They go up, and then they come down. And then sometimes they go down, and then they go up a little bit, and then they go down more. And then they come up and down. And it's just the nature of the beast, all right? Doesn't mean that the company's going out of business. Doesn't mean that, you know, Jesus is on his way or anything like that, all right? It doesn't mean any of that. This is the nature of the beast. It's been doing this for 200 years, okay? And Jesus hasn't come back yet. So just because the market falls doesn't mean that the whole world's collapsing. It just means that people who made a lot of money in this session are now taking profits during this session. All right, because you got to sell it. Remember, these are growth stocks. So the only way you make money is you got to sell them. And so people start to sell them to take their profits way up in here. They made a whole bunch of money. They need to go buy their new Tesla. So what do? They have to sell their stock so that they can go buy their new Tesla. And then if they go and sell their stock, well, that makes the market go down. So if lots of people made lots of money coming up in here, well, now it's time for them to sell it so they can go buy their new Tesla, and that's going to make the market go down. Once it goes down and they've gone to work and they've worked for another couple of months and they've got some cash in their pocket, they'll start to buy again, and then that'll start to make the market go back up, and then they'll want to buy another new Tesla out here a year out, and they'll do the same thing. That's why the market goes up and down, because there's profit taking. Now, we're going to go into another world. We're going to pass this buy-sell, nightmare, and we're going to go into a yield-first strategy. Okay, we're going to go into yield first, and I'm going to show you that, and that's what we're learning in this class. So that's American Express. This is Costco. Now, Costco's already, made lots of money, and everybody decided taking some profits. Oh, we're going to buy some more. Oh, no, we're going to let it go down. Oh, and it goes up and down, right? Markets go up and down, and it's come down. If we take our little measuring tool from the low to the high, right? Where's Costco come back down into? Well, it was way up here high. Now it's come back down into this into this lower zone. That's why we got this big buy. Everybody bought it. But then not enough people decided to buy it. They made a whole bunch of money there, so they started to sell it here. Take their profits. And then they started to buy it, and then some more people sold out. Then they didn't want it anymore. Now they're like, oh, maybe it's not good. I'll buy it low. Sell out now and then wait for it to get lower, and I'll buy some more. So now it's way down here in the bottom. People are starting to buy up Costco. Okay, so this is big buy zone down in here. See all this green, buy. Oh, I don't want to buy Costco. It's doing poorly. No, people just sold out because they're making all their profits. Now it's time to buy Costco down in here. This is why people have such a hard time trading the growth side of trading, because they don't want to buy a stock that's doing poorly. Oh, this poor market's doing poorly. I don't want to buy it. No, that's exactly when you want to buy it. You want to buy it when it's down here, because if you bought it up here, look, you'd be sitting through this thing losing money all the way down here. And then the market, you're going to have to wait till next year. You're going to have to wait for the next year for the market to turn around and start to come all the way back up just to get you back to break even, right? Hold on a second. I've been losing my voice really bad today. Probably talked too much last night, and I come try to talk again. My voice like, what are you doing to me? All right. So that's why you don't want to buy high, because if you buy high, then you have to wait for it to come all the way down here, and then everybody else is going to buy down here, drive it all the way back up just to get you back to break even. All right. So you want to buy down in these locations if you can, down here in these bottoms. That's the best place to get into that. That's Costco. This is JP Morgan Chase. Now, it doesn't mean you can't make money if you buy up here at the high points, right? Like this is a high point. This market was way up here. And if you would have bought it right here, well, it still made some money, still going up, right? Just a little bit slower. It was going up faster here. Best time to buy is back here. Well, you can't buy back there. Why? Because that was last year. So now you have to look at where the market's at today and find low spaces to buy it. And you can not buy it at all, or you can sit and wait. You can say, well, I'm not going to buy it at all. Not even buy these dips, because I'm going to wait for it to come back even more. Maybe it'll come way back down here, and then I can buy some. Okay, well, do that. But then you're not going to be in the market. So you're going to sit on your hands for a little while, waiting for the market to come back down. And all these people who made all this money over the last year, they're going to start taking profits so they can go buy new Teslas. And then this is going to come down, up. Maybe we'll see this come down again. It'll go up, then it'll come down again. And then you can be down here in what we call the Fibonacci sweet spot. And that's where you want to start buying into this market. All right. So that's kind of where this sits. And that's why I've got that Donchian channel over the top of this market, because it comes in and it kind of tells you where these pullbacks are. Now, if you were looking at this earlier, see the Donchian channels and the Fibonacci was here, and you were waiting for it to come back down into the market back here, and it never did. It broke and went higher. So you're like, oh, well, that sucks. I missed out on that. So then you raise this up again. And if you keep waiting for the market to come down, sometimes the market doesn't come down. and you miss out, but that's okay too. I mean, you know, you go find another market, one that's giving you a pullback. But there's some markets like that just keep going up, and there's a few of those, and they're nice when you catch one of those in one of the dips, because they just keep going up and up, and that's how you get lots of growth. All right, so now we're going to come in here. Look at this. This is Eli Lilly. So Eli Lilly coming in here. Man alive, that baby took off. Nobody wanted to buy it down here. Why not? Because, oh, the Eli Lillies are doing really bad. I don't want no Eli Lilly. It's doing really bad. I want to only buy good stocks. So you bought it up here, and you bought it up here, and you bought it up here. And now you're ready to buy it up here because you're like, oh, Eli Lilly's doing really good. I'm going to buy it right here. You got to buy markets that are down here, down here, down here, down here, down here, not up there. All right. It's not rocket science. We're not sending Elon's truck to the moon, car to the moon. All right. So you got to buy down here. And that's what these little indicators tell you. All right. Again, we can use MACD if you like it. It's a little bit more sophisticated than the CMF. Has more colors, so it gives you a little bit more of an idea. See, so right there, that's a nice place. See how it went red, 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 and the first big green right there, right there. Here's another spot right there. Look at that. Kind of tells you when to get into these markets right there. Tells you when to get into these markets. Not rocket science. And then on the other side, tells you when to get out right here. See that? Goes green, then it goes red. Well, that was right there. Don't buy right there. You know, you're like, I want to buy right there, land. don't buy right there. Now it's going green, green, green right now, but I don't know how far. But every time it's gone green, 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 usually we get some reds. So it's green right here, but it hasn't gone red yet. But I don't know. I'm looking at that. I don't want to buy that right there. Do you? Do you want to buy that right there? I want to get into Eli Lilly. Okay, well, wait for it to pull back, give you some reds, and then the first green candle. Right? First green candle, if it corresponds with the MACD down in here, first green candle, you can start to buy right in here. See green candle, first green candle, first green candle, first green candle. All these first green candles are the breaking of these nice little blue lines. Those are the best places to get into these markets. Okay. Let's go look at Oracle. Jay says he's going to change the colors of his candles so it comes the other way. You could do that, you know. You could do that. Watch, let's do it just for fun. Just because Jay said it, we'll come in here and goof off. That's what labs are for. All right. In the class at night, we teach the academic side of things, and when we come out here in the lab, we get things like this, right? Where Jay's saying, I think I'm going to change the color of my candles so that they're the other way around. That's where you come into the lab. That's why we come to the lab. So Jay says, what if I did that? Well, we can do that, and you can see what it would look like just for fun. You can try some of that stuff. That's why we're in labs, right? So let's come in here to the chart preferences. We're going to slide down to the color coding of the bars. And so if they open higher right there, that's green. We're going to change that one. Jay says change that one to red. Okay, so we're going to change that one to red. Can you do that? Sure, you can do it. You can do whatever you want. You're in charge. Where's red? Oh, there it is. And then we'll make this one green. So we'll change it to green. So Jay's got kind of a funny idea here. There you go. Now, buy when it's coming down, and red when it's going up. There you go. Jay's got a grand idea to kind of help him see which ones are when it's time to buy, when it's time to sell. You want to do it that way? Do it that way. It's not the traditional way, but hey, being a little bit different sometimes can help you make money. Nothing wrong with that. So that's just kind of a fun little experiment you can do with yourself and see if that's the way you want to do it. So you can see the first. So right there, that would be your little buy signal. Right here, this would be your little buy signal, right? You got little buy signals in here, but they're after already a big, long run up. So we want a bigger downtrend before we get in. You can get in. Nothing wrong with adding on a little bit in here. If you get in here and it goes up, then it gives you a little opportunity here. You see where it breaks. You another little opportunity, another little opportunity. Again, remember, we look for 3 runs, 3 of these blue sets of lights. So there's drive 1, there's drive 2, there's drive 3. Once it does that, we generally expect a bigger run back down. And usually I expect a little ABC and get one more of these, but this one didn't. It was too strong. Oracle was really strong, and it broke right there, and it took off and went to the moon again. All right, so that's pretty crazy. Now it's coming and giving us that little ABC top formation. So we're getting that little ABC, and it's projecting back down again. So we could draw our Fibonacci ruler from here to here, and you can see it's coming way back down in here, but we could draw it from the bottom, which is where it's coming in right now. And so now this is our Fibonacci sweet spot right in here. So right in there, you can start to pick up some more Oracle. Oracle's good company. It's one of our blue chips, right? So right in here, it's coming down into here. This would be a good place to start looking to pick some up. Now it's still coming down, so don't want to go yet. Wait. So we come down here. We'll turn on the MACD, CMF, remove. So we got the MACD coming in here. See that? So it's coming in, and it's swinging low. And as soon as that turns into a little, turns around, starts going green, you can start buying a little. And that'll probably be right down in here somewhere. It'll be in this little circle somewhere where this market's going to turn and start to turn and go back up again. All right. People start, now they wanted to buy Teslas, right? They made a lot of money. They got to sell it. That's the whole name of this game. When you buy low, sell high. You got to sell high. They're selling out up here, and that's why the market's going down. They're going to sell, take their profits, so they can go buy their Teslas, and then they'll go back to work, get a couple paychecks, and then they'll start putting the money back in, and it'll start go back up again. Okay, so that's just how you time the entry on these markets. It's not rocket science. It's hard to do because most people won't do it. They want to buy up here. They keep wanting to buy up here. Oh, it's doing well. I want to buy a stock that's doing well. And they buy up here, and then they have to sit through these big long drawdowns. They lose all their money, and then they gets down here and they sell. So they buy high because they want to do a stock that's going well, and then it goes down, and it goes up, and then it goes down again. And then they're like, oh no, it's going to just keep going down. I can never make money at this stock. So they get out right here. So they buy here and they sell here. And that's what most retail traders do. That's why I told you in class, most retail traders lose money doing this because they always want to buy a stock that's doing well. So they do this, they buy up here. And then when it comes down here, they sell down here because, oh no, it's doing poorly, and I don't want a stock that's doing poorly. They should have bought down here and sold up here, but they won't sell either. So they'll buy down here, and then it'll go up here, and they'll never sell. Okay, well, that's fine, because if the market comes down a little and it goes back up, oh, I'm so happy. Oh, I'm so happy. Oh, I'm sad. Oh, I'm so happy. And you just ride through it like that. And then, sometimes that works out and it's way up here, but you never take your profits. Then if you never take your profits, you can't go buy no new Teslas. Okay, no new Tesla for you. You just left your money in the market. All right, so here's Walmart. Again, Walmart did that big thing here too. We come back and look. Walmart had that big, huge, massive run up here. Wow, people making all kinds of money. Look at the 3-drive pattern back in here. You got drive 1. Come on, man, grab the tools. Drive 1, drive 2, drive 3. See how it does that? 3 drives, and then it gets the big red back. Now, again, I expected a little bit more here, and it didn't give it to us. It took off and went and made a nice big 4th drive, which is pretty cool. Doesn't usually do that. All right. Usually it comes back and gives you a little ABC coming back off the 3rd one, but this one went to the 4th. That's when everybody dumped all their Walmart stock and went and bought their Teslas. Okay. So now they're taking profits, and that drives the market back down, and then that gives you an opportunity to get back in down here. So there's where you get back in. And then the market went up, and then it just kind of died for a while. Just went sideways for a long time. And notice it did 3 more of those. Drive 1, drive 2, drive 3. That's called 3 times a charm. When a market goes sideways like that, it's usually on that 3rd charm, again, that we expect it to take off and start to move. And it did a little bit. It didn't go up like a rocket ship. It didn't go off like one of Elon's rocket ships, but it did go up. Now we got 3 more drives. We got drive 1, drive 2, drive 3. So, well, not very strong there, Walmart. So we got Walmart coming up in a nice little trend line. It's trying to stay up there, but looks like it wants to drop again. I don't know. It's red. It's coming down. It's trying to be green down here. We might get a little bit of a green and maybe another red. That's what I would expect. Doesn't mean it has to. Come down, and then it could take off and keep going up like this. I don't know. It's all a crapshoot, right? So I call it a carnival. Trading in the stock market is like a carnival game. All right, it takes a little bit of skill. It's not betting. It's not like going to Vegas and betting. It's not that. Trading the stock market is not betting. It's a carnival game. Okay, betting, you have the exact same odds every single time you roll the dice, or every single time you spin the wheel, or every time you have your cards. You have the same odds every single time, and the house always has the odds, right, against you. Well, the stock market is not that. The stock market is a carnival game. So a carnival game means that you can still win this thing. You just have to have some skill and understanding. You go to the carnival game, you can come out with a big panda, or a big bear, but you have to have a little bit of skill. Okay, they're usually set up so that you can't win, and that's the stock market. It's kind of built so you can't win. It's hard to win because you have to buy low and sell high. Nobody wants to do that. Everybody wants to buy high and sell higher. That's a really hard strategy. Buy high, sell higher is a really hard strategy. So I like to buy low, sell high. And that's a hard strategy. So, you go to the fairway of the carnival game and you start throwing basketball hoops and you're like, well, I played basketball my whole life. I'm really good at basketball. And then you go to the fairway and you start throwing basketball hoops and you can't make a damn one. Why? Well, they've made the hoop a little bit smaller and they put it farther away and it's at a different height. So nothing's the same as what you're used to, but still throwing basketball into a hoop, but you can just practice and you can get good at it and you can still do it. So that's how playing the stock market is. All right. So that is Walmart. So now we've looked at the Magnificent Seven that was in our list, right? The Magnificent Seven. And we also looked at the blue chips. So we've looked at these two. That's level one trading, all right, as we talked about in class last night. That's level one trading, meaning that you're just buying low, selling high. And that's the whole name of the game. And that's what 90% of most traders do. Okay, that's the most popular way of trading these markets. Now, remember, we went into level two trading, which is the dividends, right? So the dividend stocks, and we'll come over and look at a couple of those just for fun. But a dividend stock is like, I probably have a list of a whole bunch of them in here. We're top 10 dividend stocks by popularity. So here's some dividend stocks. Now, the dividend stocks, you're going to do the same thing, right? You're going to come in here and you're going to try and buy low because the dividends on these stocks are so small that they're almost like, why bothers, right? They're going to give you a couple bucks. Who cares? But it's still important. There's still dividends. It's still rent on your house. You bought a house, but the rent's just really low. All right. You bought a house for $200,000 and the rent that's coming in is like $50 a month. All right. So sure, it's still rent, but it's just not very good rent. Okay. On a $200,000 house, you should be getting a lot more than that. So you still have to go off the growth. So you still have to buy low and sell high and worry about the growth. Now, this is Coca-Cola, which has some dividends. Kimberly-Clark has dividend. Oh, look at Kimberly-Clark, fell right out of bed. So dividends aren't going to help you there. All right. There's U.S. Oil. That's one. There's Verizon. I don't know if U.S. Oil has dividends. I think we just pulled that up because we wanted to look at oil. There's Pfizer. Get the jab. This is Pfizer. And then we've got Altair. It's Pfizer. It's not Pfizer. I know. I just like to make fun of companies. Pfizer is a dumb name. All right. So now we come in here. Kimberly-Clark. Holy cow. Kimberly-Clark just fell out of bed. Or did we already say that? Or are they all falling out of bed? CVX. Look at this. A lot of these are just dying. Man, they're dying hard. Pepsi's coming out of bed. This is good because it's going to give you an opportunity. Those of you who don't have some of this stuff, if you got it, you're crying the blues, right? Oh no, my stock's falling. But if you're looking to get into the market, hey, it's buy the dip. Buy the dip. That's what we're looking for, right? We're waiting for these markets to pull back. We've been waiting for this for a long time. We've been waiting for these markets to pull back. They've just been going straight up forever. Stocks can't go straight up forever. They just don't do it. They got to pull back eventually. People got to take the profits so they can go buy their Teslas. And now, that's what's happening. You're seeing some of these fall out of bed. They're really dumping. So once they get down in here, maybe it's time. This one might be on the rebound. So this has been coming down, 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 down. Now it might be going back up. So we might be seeing some opportunity to buy into to Coca-Cola. So let's play with Coca-Cola. It's got growth like we've been talking about, but it's also got dividends. So let's go over and look at the dividends. So we're going to pop on over to the dividend program. All right, where's it at? Where's it at? Oh, Land doesn't have it up. All right, let's pull it up. All right, so we're going to go into the little dividend program. And I use this one just to demonstrate, but we don't really use this one when we start trading for real money. All right, I use this one as a demonstrator because it's got these little circles down here and it helps you understand. So it's good for teaching, but it's not good for application. All right. So we're going to come in here and we're going to pull up Coca-Cola. That's okay. What's Coca-Cola? I forgot. KO because we call it the KO rally, like the knockout rally. So it's KO. So let's put in KO. So this is a good little lesson tool, but it's not great for using for our purposes. All right, when we do real money. Okay, so here you go. All right, Coca-Cola. So right here is their dividends. They pay 51 cents for every share you have. Now that's pretty good money. You got to admit, for every share you have, they're going to give you 50 cents every 3 months. Now we like every month or every week. That's a lot more fun. But nonetheless, these guys do give you 50 cents for every share you have. Now, remember, the most important thing about trading for dividends, and that's what we're going to get into. We're going to move into in just a second, we're going to move into the yield max funds that we talked about. I'm going to give you a demonstration. But the whole idea is that you get your dividends paid on the number of shares you have. So that's why it's so important to buy your shares at a low price as you can. All right. So whenever the market comes down, you want to buy your shares down here because you're going to get 51 cents for the amount. You don't get paid by the amount of money you paid for the shares. They don't care about how much you paid for the share. They only care how many shares you have. So the name of the game when you're going to pay for yield, when you go for yield, which is yield first, which is the number of shares you have, the name of the game is more shares. And the more you can get at a lower price, the better you are. Okay. So you want to buy low. It's really important when you're trading for dividends that you buy the shares at a low price because that gives you a higher percent increase, all right, on your yield. So right now you're going to get 51 cents on each dividend that you have. And right now dividends are each share that you have, and each share is $68. So if you bought your shares up here and you paid $74 for them, well, you're still going to get the same 51 cents per share, but you paid $74 for them. I paid $68 for them. Therefore, we're both going to get 50 cents, but I'm getting a higher return on my money, right? So the whole name of the game is to dollar cost average the cost of your shares down. And when we get into the yield max funds, I'm going to make a kind of a bold statement here. Don't ever sell them. Once you buy them, it's sunk cost. All right. Because I want you to start thinking about the yield max funds, not like the growth funds. The growth funds, you got to sell them to make the money because the yields are not big enough to live off the yields unless you have millions of dollars in there. Okay. If you're Warren Buffett, you can live off the dividends. But if you're just little Land Turner and you don't have $2 million in your bank, you can't live off the dividends because the dividends just won't be big enough to cover your expenses. All right. You're going to have to live pretty low on the hog to live off the dividends alone on something like Coca-Cola, unless you have a lot of Coca-Cola in there, 500,000, 700, 800, 900, $1 million in here. So let's take $10,000 because we like to use $10,000 as our average here. We're going to take our little $10,000. We're going to invest it in Coca-Cola. So put $10,000 into your calculator, divide it by the number of shares. There's $68 per share. So we're divide it by $68. How many shares are you going to get? You're going to get 147 shares. So they're going to give you 50 cents every 3 months for those 140 shares. So 147 shares times 0.51, that's $75 on your $10,000 investment every 3 months. You divide that by 3, that's $25 a month on your $10,000 investment. It's not enough to live. All right. You might be able to go down to Liberty and get some eggs for that. All right. Once, but you're not going to be able to to live off of that. And so you got to have a lot of money in these yields, these growth stocks that pay a dividend to make it worth your while. Okay, so that's an example of Coca-Cola. And of course, there's a bunch of them. We talked about a bunch of them in here. I give you a list of them. Last time, did I still have that list in here? I do. So here's the dividend aristocrats. So these are high-paying dividends. You can see that this is 6.4%. This is 5.8%. This is 5.23%. So this is your what we call dividend aristocrats. They've raised their dividends every year for the past 25 years. Generally stable companies, 2024 dividend amounts. And they're basically the same 2025 dividend amounts because they stay pretty consistent with these rates. Now they're going to probably go up a little bit because they do raise them every year. So let's go look at Franklin Resources, Ben, which does 6.4%. Now remember, a lot of the reason why dividends go up every year is because the stock goes down. Now it's not always the case, but let's pull it up and see what the stock's been doing. Stock's been, it did nice. It went up. Then it's coming back down. It's back down into the buy zone, isn't it? If you were to draw your 50% ruler in there, you'd see that this is right close to the buy zone. You can start buying into Ben Franklin and you can get some shares. So let's do $10,000 in Ben since he's got, and see what his rate is. So 32 cents for every share, and shares are only $22. So that's good. See, the share price a lot lower, $32, and it's every quarter. So we're going to go in, we're going to put our $10,000 in. So put in $10,000, and then we're going to say divided by 22. That's 454 shares times 0.32. It's going to give you $145 every 3 months. Now we're going to divide that by 3, and it's $48, almost twice what Coca-Cola gives you. Okay, so Ben Franklin Resources gives you $48 every month on average for a $10,000 investment. Still pretty tough to live on that. Still pretty tough. Probably you might be able to buy you and your wife or your girlfriend. Probably not at the same time, but you could probably buy your wife or your girlfriend some eggs at Liberty. Okay. All right. So there you go. That's Ben. And I'm going to bring those back on for those of you who want those. Go ahead and bring your little camera up for those of you who haven't got this, and take a picture of that screen so you can see those dividend aristocrats. All right. Give you a second to take a photo of that. Okay. All right. So the next one, this is a list. While you got your camera out, take a picture of this one, because this is the dividend yield table I built. And you can see that the dividend yield table has more than just the aristocrats. This has all the big companies. So McDonald's and Intel and JP Morgan and Caterpillar, ExxonMobil, Pepsi, Johnson & Johnson, Apple, Pfizer. It's got everybody in here. All right. The Rectal Campbell Company. Procter Gamble. And then the Starbucks Corporation, and then Home Depot. They're all in here. And it shows all of their dividends. And you can see I've got it sorted from top to bottom. You see Verizon is at 6.78. or when I did this table. And then down here at the very bottom, 0.44 is Apple. Apple's at the very bottom. Apple's got a skinny heart. They're skinny hearted. They don't give you a big dividend. All right. They claim that they're a growth company, even though they're one of the largest companies in the whole world. Oh, we're a growth company, so we don't have to give you dividends. You're the biggest company in the whole damn world. You're not growing anymore. So come on, give us some bigger dividends. No, we're skinny hearted. All right, so that's Apple. Those of you who know, I'm not a real big. I like Apple. I got their products, right? Here's an Apple iPhone. Here's an Apple iPad. I have their stuff. I just don't like them as an investment company. They picked up a little bit. I have to admit, they've done a little bit better in the last 6 months. So can't complain too much about them. But they do buy back all their shares. I'm not going to go down that road. I do it all the time, and I know it's a rabbit hole I hate, but let's go somewhere else than Apple. Apple gets under my skin because I want them to do really well, and they just don't. They do a lot of stupid things. All right. So nonetheless, that is that one. So now what we want to do is we want to come in and we want to start talking about the yield max funds. All right. And the yield max funds are going to change our entire thought process of how this thing works. So the yield max funds, remember, we're going to put our money in and give it to somebody else to trade for us. We're not going to trade it ourselves. We're not going to buy low, sell high throughout the process. We're going to give yield max our money, and then they're going to go and trade our money for us. So we're going to throw all our money into the bucket of yield max ETF. It's a single stock ETF. There are some that are not single stocks. They've got multiple stocks inside some of their investments, but for the most part, they start off with their single stock ETFs. That's what's made them famous. And then they trade your money for you. Okay. So remember, you're giving them your money, and then you want to let them trade it for you. So what we're going to do is, this is called level 3 investing. All right. So level 3 investing. So we're going to go in and we're going to talk about these funds right here. This is the list of yield max funds. Now, there's more than just yield max. When yield max is kind of the ones who pioneered all this. They're the ones that started doing all this. And so there's been other companies who have followed in their footsteps. And I talked to you a little bit about those yesterday in class, and I got a list of them. So here's the list of other companies who do this besides yield max. Now, just because I love yield max, and the reason I love yield max is because the way they trade for me, they do it the way I like to trade, which is with options. Okay. And they do covered calls, they do synthetic longs. I'm not going to try to explain the whole concept of what they're doing with their options, but they're doing options trading, and that's how they get the big yield. That's how they get that big dividend. Okay. Is because they're doing options, which is leveraged. And it's through that leverage that gives them the ability to give you a bigger dividend. So you buy into their fund, and then they go out and trade it using options and put the money back into the fund and give it to you. And then they give you a distribution, or they give you your dividends every week, not every 3 months. So that's kind of cool, right? You get a paycheck every week. They used to do it every month. And that was really cool. We like to get our check every month instead of every 3 months. But then they switched. Now they do it every week. And so most of these companies are actually doing it every week. So you got in here, you got yield max, which is up here in my, this is Grok. So Grok, this morning, I said, hey, look, we talked about these other funds. What's the other companies besides yield max? And so it said, besides yield max, there's Granite Shares. So take your little camera and photograph this picture, or you can go ask Grok yourself. But I had already been having a conversation with Grok, so he knew what I was talking about, and so he already knew how to go get this. If you've not been working with Grok, he's going to have to go do all the research again, and you're going to have to kind of lead him, guide him, walk beside him to help him get the information you want, like I did. So go ahead and take pictures of mine so that you have them. So this is Granite Shares, different company, not yield max. Remember, these are all firms that do this type of trading. They've all jumped on the bandwagon. Yield max was the first. They pioneered it. But then Granite Shares came in and said, hey, yield max is doing this. I want to do it too. So they created some funds that they can do. And then this is Round Hill. Round Hill did the same thing. Oh, well, look what yield max is doing. We want to do it too. So they started doing it. Curve is another company that started doing it. Defiance is another company that has a couple. They just jumped into the ring. Axis Investments, they jumped into the ring. Neos, they jumped into the ring. Nicholas Wealth, they jumped into the ring. They've got one called Blocks. And so there's a bunch of them in here who are starting to do this. All right. And this is not a religion. All right. We don't belong to the yield max religion, and we can't go and dabble in other companies' pots of money. We can certainly do that. All right. We're all on the same team. We're all trying to make money. We're all trying to do what's best for ourselves. And these guys are offering us services. They will trade for us based on their strategy. So many of these use a different strategy than yield max. Yield max uses a strategy of synthetic longs and covered calls. These other guys, some of them will use just covered calls. They'll buy the stock and they'll do the covered calls. Some of them will do the synthetic. Some of them will go do them on different types of stuff. There's just different strategies of doing the same thing. I like yield max because they do the way I trade. All right. So I kind of lean towards that religion. All right. They believe what I believe. So I like to invest with yield max. Doesn't mean that that's the only place. There's other places. Granite Shares, I love the way Granite Shares trades. They do options instead of long calls. And I like that. And they have some good stocks. I have some of Granite Shares. So I'm a little bit Mormon. I'm a little bit Catholic. All right. I like a little of both. Okay, if you're going to talk about it from a religion. The problem is people start thinking about it like a religion out on the YouTubes and out on the Twitters, and you have to just ignore all that stuff. You guys know more about trading these markets than any of those guys out there if you've been to my classes. Most of those guys out there doing their math wrong, and they don't know what they're talking about. All right, so if you've been in my classes, you know more than they do. So just ignore what they have to say. There's very few people out there who really understand these. They're so brand new. Yeah, Rock's making a good point. He says, don't jump into them brand new, because almost every single one of them get overvalued on their IPO. When they IPO them, which means the initial public offering, they oftentimes flush. Almost all IPOs do. I mean, almost everything that comes out. You go look at even Meta, Facebook, that's making billions and billions of dollars in their stock right now. When they first came out, they flushed and went down and went flat sideways for a long time. These stocks do the same thing. They overvalue everything. So when they overvalue them and then they flush and they come down, and then they start to level off, and that's level off point is the point that I think you can start getting into them. So in fact, Rock makes a very good point there. Let's start with one that did that. Let's start with TSYY. TSYY, it's a Granite Shares. TSYI, they got TSYI in here. I think Grok made a mistake on that one because it's TSYY. I tell Grok to go double check that, but it's TSYY. So we're going to go look at the Granite Shares, but I want to do mostly, we're going to come in here and we're going to do the Yield Max. The Yield Max is still my favorite out of all of them. I like Yield Max because Yield Max trades the way I trade, the way I've always traded, which is with options. Okay. So where's my actual combined portfolio? So here we go. Actually, this has too much stuff in it. We're going to come in here and start a new one. We're just going to call it Yield Max. And I'm going to put into Yield Max. I wanted to get your camera back out again. I didn't finish scrolling this down. This is Granite Shares, Round Hill, take pictures, Curve, Defiance, AXS, Neos. These are some that you can go look at. We haven't really done much with them. The ones that I've looked at most are the Round Hill. I've owned a bunch of Round Hills. I've owned a bunch of Granite Shares, and mostly right now, all of mine are Yield Max. I don't have any of these. Now that they're bad, that doesn't mean they're bad. Just because what I have in my portfolio doesn't mean that's what you guys need to go buy. These are some good ones. There was times in there where I felt like they were the best buy at the time. All right. And TSYY is the one I want to go pull up. And he's got TSYI. I don't think that's right. It's TSYY. Let's go look and see. TSYY, and it's a Granite Shares. Yeah, see, it's a TSYY. And see how Rock was making the point that when it first comes out, they usually flush like a toilet. And that's what TSYY did. And TSYY started to stable, and it's going a little bit sideways now. And you're like, I still don't want to buy it. It's going down. No, that's not how this works. That's not how this works. Remember, the way this works is you get paid the dividends based on the dollar amount. So if the market goes down, you're buying each time you buy more, your share price is going down. So the dividend is actually a larger percentage of your investment. Okay. This is kind of a fun one to start with because it's so big. Let's go look at it. So we're going to go over to the dividends, and we're going to do this one more time, and then we'll go use the calculator. All right. So we'll come over here. We're going to TSYY. This is the Granite Shares version, not the Yield Max version. I have the Yield Max version. I'll show you that one in just a second. So see how this is $7.63 a share? And the dividend on it is 20 cents. But that's 20 cents a week, not 20 cents a quarter. So now what we're going to do is we're going to take our same $10,000, 10,000. Okay, we're going to divide it by the share price, $6.50, or $7.65. Oh, 10,000 divided by 7.65. That's 1,307 shares. So your $10,000, 1,307 shares, and you're going to multiply it by 20 cents times 0.20. That's $261. Remember, the others were doing like $20 or $30. This is $261, and it's every week, not every quarter. So now you're going to multiply that by 4. That's $1,000 a month on your $10,000 investment, as opposed to $20 or $30 a month on the others. That's what we call yield first. Okay, yield first. And you're like, yes, but Lan, the stock is going down. Okay, let's say that the stock drops 20%. That means that rather than making your 100% return, your 100% return annually, this is more than 100%, because you put in 10,000 and in 1 year you'll have back 12,000. So it's like 120% return on your money. And you're going to say, yeah, but the stock went down 20%. Okay, we'll cut 20% off of that. You still got 100% return. That's a lot of money. All right, so I told you last night in class I was going to show you a way that you could do 50% return. Right now, I just showed you a way that you can do more than 50. You can do double that. You can do almost 100% return. Even if the stock drops 20% over the next year, you're still going to make close to 100% return on your money. And in 1 year, you put $10,000 into this little TSYY. In 1 year, you'll probably have it all back. Okay, so you have what we call a cash cow, and you'll be on the gravy train. Okay, because once you have a cash cow, you have no more out-of-pocket cost. You put 10 grand in, it's paying you that much money, and in 1 year, it will have given you all your money back. Your whole $10,000 is back, and then everything it gives you after that is gravy train, free money. I can't make it any better than that. That's pretty good. You got to admit. And you saw my account, so I'm not just blowing smoke. I showed you last night in class my real money account. I'm really doing this with real money, and you saw how much money I was making. And I've been doing it for over 2 years now. So I know it works. It's not pie in the sky. It's real. And it's not a Ponzi scheme. All right. They are trading your money with options on leveraged accounts. That's how they do it. It's a real thing. They really can do it. They can really make that kind of money, and they can really share it with you. And they're really doing it. And they've only been doing it for a couple of years. It's all brand new. All right. So this is one that some of our students are in, TSYY. They put their money in there. Now, would you be a little bit more sad if you bought it up here? Yeah, probably. Take you a little bit longer to get your money back. You paid $25 per share when you could have now buy them for $7. But you'd still be making the same amount of money. You'd still be making $1,000 a month on your $10,000 investment. It just, to get $10,000 in there, you only got, well, you wouldn't either, because you'd have fewer shares. So by having this market, if this market turned and shot and went way back up, you would be sad. Because then to buy more, to compound, do that extra compounded interest, right? Compounded interest, to buy more of them, you'd have to pay more for them. And then you don't get as big a return. Bureaucrats saying, just remember, this is a longer term strategy. You'll hurt if you keep pulling your money in and out of this thing. And we talked about that last night in class, right? Last night at the university. That was one of the things we talked about a lot. We're like, are you going to put your money in and then pull it out, and put your money in and pull it out, and put your money in and pull it out? Oh, I'm making money. Oh, I'm losing money. Oh, I'm making money. Oh, you're just looking at the growth side. This is not growth. What Boost Crate is saying here is this is not a growth strategy like we were talking about with the previous ones. We've switched. We've now gone to yield first, right? So we have growth first. Now we're doing yield first. So yield first. So let's go look at some of these other stocks, and I'll show you some of the, in fact, I'm going to pull you up. Well, I got the Yield Max. Let's go over to the websites, because I wanted to show you the websites. Actually, I've got them here. I was going to go over to the website and get this list, but I got it right here. This is our Yield Max fund. So go ahead and take those of you who didn't get a picture of them last night in class, get your little camera and take a picture of this. This is most of the Yield Max funds. Now, they keep adding more. Okay, and one of them that we just looked at is TS Granite Shares. This was Yield Max. They have TSLY. All right. Now, the license plate on my car is TSLY. Did you know the license plate on my car? The other license plate on my other car is PLTY. So I actually, on my license plate on my Tesla, I ordered it, TSLY. It just hasn't arrived yet. I'm waiting for it to show up. TSLY is going to be the license plate on my Tesla. But on my little Audi, it's PLTY. So I've got that one. That was pretty cool. PLTY is that's a pretty cool license plate. All right. All right. That's where I'm making all my money. A couple of these. So TSLY is Tesla. So this is the TSLY version. Now remember, this is the bucket of money that you put your money into, and then they use this money to go and trade options on Tesla. When they make money, they put the money back into this fund, into this bucket of money, and then they distribute it to you. So what Bruce was explaining to you last night that I probably didn't make very clear in the beginning was, I said you're going to give your money to Yield Max, and they're going to go trade options with it. You don't actually send your money to Yield Max. Yield Max is the management firm that manages the ETFs that are on the exchange. So the way you give your money to Yield Max is by putting your money into this stock symbol. Okay, so this stock symbol is TSLY. It's on the stock exchange. You buy this stock symbol through your brokerage firm, however you do it, whether you do it through track and trade, you can do it right here. You can just come right in here. You can go trade, and you come in, you say, I want to buy 100 shares. You hit buy. Boom, that's it. You've got it. Now you are in TSLY. That's what's so great about a trading platform. You can just come in here, and right here where you're looking at your charts, you can also have your purchasing, and you have all of your accounting down here underneath. So that's why you have the Ferrari of trading platforms. If you don't want to pay for that, there's other ways you can do it for free. It's just not this easy and simple. You can use your little phone, and then you have to do all the stuff to tell it what you want to buy and stuff. And then you don't get to see all the charts and stuff. You have to go out and you have to use programs like this to help you understand what the charts are doing. All right, because the little program doesn't do all that. If you want it all in one place, this is a great place to do it. Okay, so I'm going to leave that in there. We'll just leave that in there, the 100 shares. All right, so that's TSLY, and notice that it just goes flat. It's not a growth stock. You don't want this one to really go up a lot. You just want it to go flat. And over a period of time, that's the best thing this market can do, is just go flat. Because what that means is that they're giving you all the profits that they're making. Because Tesla's been going up, and they're making money on the growth side, but that just means they're trading options, taking that money out and giving it to you. Because remember, every time they make a distribution, every time they send you the money, this market goes down. So see this big run right here where it went up, 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 and we still got our stocks turned backwards. It's green coming down. So we need to go change that back. How are we going to change that back? I want to change it back. I don't want green on the downside. People look at that and they'll go, what the heck is this guy doing? Chart preferences. We come back down here and turn those back the way they belong. Green. So we'll go with lime green, and we'll go with red on this one down here. All right, we're back to normal. Back to normal. Save as my defaults. Update all charts. Okay. So now when the market goes up, that means that they haven't given you all the money that they made. They didn't distribute all the money that they made to you. When it goes down, now they're distributing all the money they made to you. What you really want this market to do is just go sideways. This was the initial offering back in here. This is when they first got in. That's why the market dumped like it did. That's why you don't ever want to buy into these things brand new, right? So we want to just wait for them to settle down. And then when they start going sideways, they kind of got their mojo. And so they just, as they make money, they give it to you. So this stock will not go up. And that's good for you because you can always buy your stock at a lower price. If it went clear up, if the stock went all the way up to $20, you'd be sad because now you have to pay $20 for them, and they're not going to be able to make any more money. The options are going to make about the same money. They're going to trade about the same amount of money as they would if they were at $80, as if they were at $8. So your dividends would be way lower because the stock is way higher. So you don't look at these stocks as if, oh, I'm sad, my stock's not going up. You don't want your stock to go up, okay? You just want those big dividend payouts. So this is TSLY. This is the Yield Max version. TSYY is a Granite Shares version. Granite Shares trades put options. TSLY trades synthetic longs with covered calls. So it's a different strategy. Okay, not that one's any better than the other. They're just better in different situations. They're just different. Okay, they're not better or worse. They're just different. And depending on what the markets are doing, you might want to choose one or the other. So we're going to come in here and go to TSLA. Now, TSLA, Tesla is the underlying stock, right? This is the actual stock. This is Tesla. Tesla doesn't pay a dividend. So if you own Tesla, you have to buy it low and sell it high to get your money so you can go buy a Tesla. But this one here, we buy it and we never sell it. I'm going to say something very bold. When you trade these stocks, you never sell them. Once you buy them, it's sunk cost. It's like a business. You went and bought yourself a machine that makes steering wheels, and that steering wheel machine, you're just going to hold on to that steering wheel machine no matter what the value of the steering wheel machine is, whether it goes up or down, doesn't matter. It's the cost. You make all your money from the steering wheels that are coming out of it, because you're going to sell steering wheels. All right. But the cost of the machine that makes steering wheels, you're never going to sell that. It's just your sunk cost. Eventually, you'll sell enough steering wheels that'll pay for the cost of the machine, and then everything after that, it's a gravy train, right? That's how you go into business. You buy equipment. The equipment you use. The problem with going out into the real world, the equipment's going to get old and wear out. You're going to have to buy a new equipment. Well, that might happen in here. You might buy into a Tesla, and Tesla, the underlying stock, may just keep going down, down, down. And TSLY, because it's part of Tesla, makes its money off of Tesla, it might go down too. That machine might eventually wear out, and you have to buy a different machine. But as long as Tesla, the company, is doing well, the underlying TSLY is going to do well too, because it's trading Tesla. There are markets that they've got into, YieldMax has bought into, where the stock just kept going down and the dividend couldn't keep up with the loss of the stock. And so it was a bad investment. That happens. I only know of one that's done that so far, but it happens. There's the case where you could have a stock that's doing so poorly, YieldMax is trading it and they just can't keep up. And it's not a good investment. So in that case, you might want to roll your money out, take your lumps, just like any other thing. You can lose money doing this. All right. You can lose money doing this, but for the most part, it's about as good as it gets, in my opinion. All right. So that is TSLY. Let's quickly do a math on this. Now, I'm not going to do it manually with well, let's do it one more, just to do a comparison between TSYY and TSLY. All right. We did $10,000. We're going to come over here. We're going to put in our little TSLY. So this is the YieldMax fund, and it's paying out every week. See, it used to pay out monthly, but they started paying out every week now. See, every week, little dots here. And they pay out 11 cents, and it's $8. So we're going to take our share price. We're going to do the math again. We're going to come in here and go $10,000. So you got your 10,000. Divide it by 847, 8.47. That's 1,180 shares times. And what did they pay? Let's look at an average. This is 11 cents, 16 cents, 19 cents. So an average of 20, 10, let's say 15 cents. On average, we're going to do the middle one. All right. So we'll say 15 cents. So we're going to say 1,180 shares times 0.15 equals $177 a week times 4. So you're going to make $700 a week on TSLY with your $10,000. So a little less than TSYY, right? TSLY is not making as much as TSYY. See that? But it's still $700 on a $10,000 investment every month. In about 12 months, right? You're still going to get all your money back. Whereas TSYY give you all your money back in about 10 months. So that's pretty cool. Does it mean you have to have one or the other? No, it means you can have both. Have one of one and one of the other. Or just have the TSYY. It doesn't matter. Again, like I said, it's not a religion. This is not Protestant and Catholics. This is not Mormons and Catholics. This is whatever you want. You know, these are all good, and whatever the math is working out to be best for your portfolio at this time. But I do want you to just say, if I put my money in there, I ain't going to jump in and out, because it's going to show you the value of this TSYY stock going up and down all the time. But that's not the value. The value is what they're taking out and giving to you. The reason it goes down is because they took the money out and sent it to you. That's what these little circles mean. That means they sent you the money. Now, how do they send you the money? It comes out of the account. It goes into your cash account in your trading account. So it becomes, in this one here, it becomes buying power. All right. In this one here, you come over to your here and it comes in and it says buying power right here. Your buying power will go up every week. Your buying power will go up, give you more money. All right. If you're using a little app on your phone, it might just be putting it into what they call your cash account, and it gives you the buying power over there. Okay. So you got the ability to buy more. So then you can go buy more. And that's what we call your compounded interest, or your exponential compounded interest, because you're taking your free money and you're buying more shares, which is then going to give you free money on free money. So the free money grows really fast. So it's free money on top of free money on top of free money, free money on top of free money. That's called your exponential compounded growth. And that's how you get wealthy fast. All right. With exponential compounded growth. All right. So that's all I have to say about that. Let's go in and look at a couple more stocks. We'll go over to a couple of these websites. I'm going to look at Palantir, PLTY. I love this one. All right. This is a great one right here. And we're going to look at the underlying stock. Again, this is just a bucket of money that you're putting your money into, PLTY, so that they can use your money to go trade options over on PLTR. PLTR, and you can see PLTR is going to the moon. Woo, that's nice. That's lots of money. You've made all the money between where this stock is, right? See down here, and this stock is here. That's all the profit, and they've made all that money, and they give it to you every week. So you don't have to sell your shares, because they're making money using options, and that's the options premium that they give to you. So you don't have to sell your shares. 4, 5, 6, 7 BS wants to see ULTY, ULTY. So this is the Yield Max ULTY fund. Now I don't have this one. A lot of people have this one. I'm not a fan. Not many, that it's bad. I'm just not a fan. I don't have this one, and it's been going down pretty good. It's not doing sideways like I would like to see it. Now, ULTY, the thing with ULTY is that it's a basket of stocks. So you can see all the stocks. If you come back over to this little program, we pull up ULTY. ULTY doesn't just have one stock. All right. Like Tesla, TSLY, or TSYY, those only invest in Tesla. So if you put your money in TSYY, the only thing they're going to do is trade options on Tesla. ULTY, if you put your money in ULTY, they're going to diversify it across a bunch of other stocks. And if those stocks don't do well, ULTY doesn't do well. Or they pay out such a high yield, they start giving you more than what they're making. They're giving you some of your own money back. That's called ROCC. We'll talk about that on Wednesday. And that's not a bad thing. Everybody's like, oh, no, they're just giving you your own money back. Nothing wrong with that. I didn't have to sell my shares to get my own money back, and I don't have to pay taxes on it. So they're just trying to give you some money back so that you have enough money to pay your bills, because they make an agreement with you where they're going to try and make enough money to pay your bills. So if they give you some of your own money back, they're just giving some of your own money back faster than what they normally would. That's not a bad thing. All right. You don't have to pay taxes on it because it's your own money. And you didn't have to sell your shares to get your money back. They're just giving you your money back faster. So now you're a gravy train, cash cow, much more quickly. All right. So in ULTY, this is one of the stocks that has more than just one stock in it. So this is a basket of stocks, like a true ETF. It's not a single stock ETF. And these are all the stocks that they have in there. So you can see they got Rocket Lab, NewScale, Robinhood, Coinbase, CoreWeave, Rigetti, SoundHound, Symbolic, Palantir. They're trading options on all these stocks. All right. And so that's, and then that's how they make their money on ULTY. It's not a single stock. It's a true ETF. All right. So that's that one. But their yield on it is pretty high. So that's why some people like it. So let's go in and look. Actually, I'm getting tired of doing it with the calculator. Let's go into our real calculator. So now I can show you in here, and we're going to go to ULTY. I think if I'm logged in, ULTY, there it is. Okay, so here's ULTY. Come on, load it up, load up the data. There it is. Okay, so this is ULTY. So now we have a calculator that calculates it for us, so we don't have to do it on the phone, and it shows a historical chart. So this is in Portfolio Matrix, and this is what I told you about, in that we're going to be doing more of our work in Portfolio Matrix. And all those little charts and graphs and everything I've showed you are all from this program. All right. So this is where you get all these little charts. So we come in here and it shows you the gain. And you can see that the gain, if you go back over here and look, it's been going down, right? That's Tesla, O-U-L-T-Y. It's been going down. And so what is that gain over the last year? If we come back over the calculator, it shows you the gain has gone down 51%. 51%. So that's that blue line right there. See the lower blue line, how it's going down? But the yield, the dividend, so if you went and did your $10,000 and you did the number of shares and you multiply by the yield, it's going to give you a percent increase, all right? So the yield is at 91%. Isn't that crazy? 91% yield. That's as high as TSYY on Tesla, right? Almost. Actually, it's a little less, but that's pretty high. So everybody's looking at this and saying, well, it's up 91% yield. Yes, but it's down 51% over the year. So if you subtract the yield, the gain of negative 51 from 91, you're still making 39% return. 39% return is a lot of money. Even though it's a losing stock, losing 51% of its growth value. And so as it goes down, you can buy your shares cheaper and cheaper and cheaper and cheaper. You can buy more shares. You can dollar cost average and get a better rate on your money, right? So you have to start, I told you have to completely change your thinking when it comes to doing yield first. You want the stock to go down so you can buy it at a cheaper price and get a higher yield. So the yield over the last year, now it's had this big dump. If we just go back 6 months, we can see what it's doing 6 months. 6 months, it returned, it lost 18%, right? So the blue line, but the stock has still made 23%. Comparatively to other stocks, 23% is still a lot of money. Still a lot of money. You'd have to wait 5 years putting your money in Cash Valley Bank to make 23%. But now let's go look at TSLY. TSLY, that one has only lost 3% over the last year. All right. It's just kind of wandered up and down. That's the one we looked at. That's the one I have a lot of this one. And it's making 42% yield. So you're making 39% and you're not sitting through a 50% drawdown on your gain. So it might make you feel a little bit more comfortable. It's making about the same amount of money, 39%. 39% return on TSLY. Now let's go look at TSYY. TSYY. Now these guys, this is the Granite shares, and they are the ones who they trade the put options, not call options. So their gain, they're negative 37. That's from the beginning, clear back here. That's been going down, right? The yield is 73% or 72%. So they're at 34% return. 34% is still a lot of money. Still a lot of money, 34%. All right, if we just go 6%, that's 6 months. Let's go for a whole year. Whole year is 44%. All right, so you get 44%. So they're down 68%, but that's with this great big flush. They've stabilized, and they're giving you a yield of 112%, and they're not losing 68% anymore. So you can do the math. We could probably go over it. Well, we did the math before, and right now they're up over 100%. But this gain, this shows you the whole year, including that big drop at 44%. But they're not dropping like that anymore. So they're closer to, we just did the math, right, with our little calculator, it was 100%. I don't know if that'll do it. That's still only showing you a yield of 11. That's based on an annual percentage. All right. So that's that one. That's kind of a neat little calculator that shows you this, the chart, how much you'd be making if you were running your dividends, or how much if you're doing the growth. So the growth plus the dividends gives you the total return of 44%. All right, so let's go look at Palantir, PLTY. So that's got a gain, look at that, 16% on the gain because it's been going up. And then the yield is 89% for 105% return. That's why I said I got a lot of Palantir. That's probably one of the largest ones in my portfolio. And I'm making 105% return. So that's how I can come in and tell you guys, hey, I promised you that I was going to try and get you a 50% return. I can promise you Palantir will probably be in that portfolio when we make our portfolios on Wednesday. That'll probably be one of them we'll work on. All right. Now, the problem with Palantir, the problem with it is that they had really good earnings yesterday, and they PLTR. They had really good earnings yesterday, and going into earnings, everybody felt confident they were going to have good earnings, so the market rallied really hard. They had their earnings, and then the market flushed. So everybody who made all their money took their profits, and the market went down. But they've got really good earnings, and they've just been going up, 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 up. And you keep saying, well, when am I going to get a dip so that I can buy into them? Well, they're not coming back like we would like to see. And people don't want to see Palantir come back all the way into this region, but it's just inevitable that eventually we're going to get a sell-off, and we might be able to get it down to at least 38.2 and test this previous low down in here. Maybe it'll come down in here, and we can buy a whole bunch more Palantir down in here, because this is a really good company. They just got put into the S&P 500, and they're growing like a weed. So they got lots of government contracts, which is really stable for them. And they're making lots of commercial contracts. So they got lots of money. They're making lots of money. It's a good stock to be in. But you don't want to buy the underlying. You don't want to buy PLTR, because you have to buy and sell that one. If you want to go buy a Tesla, they're not going to send you money every week. If you want them to send you the profits every week from trading this, you have to be in PLTY. Now, I think Granite Shares has a Palantir too. Granite Shares, does they have a Palantir? Oh, they don't. They don't have a Palantir. They have Google, they have Microsoft, Apple, Coinbase, Amazon, Tesla, NVIDIA, AMD. So Round Hill, do they have a Palantir? They don't have a Palantir either. And then Curve, they don't have a Palantir. Defiance doesn't have a Palantir. AXS doesn't have a Palantir. They got Tesla. Neos doesn't have Palantir. So the only one that has Palantir right now is YieldMax. But most of these have Tesla. So they have Tesla, they're Granite, and that's a Y. TSYY. This is got it wrong right there. All right. Most of the rest of them are right, but Granite Shares always uses YY at the end. Round Hill, they have a Tesla right there. Let's go look at that one. TSTW. TSTW. Oh, it's not listed on that. Let's go see if these guys have it listed yet. TSTW. Yeah, they've got it. Oh, that's still Palantir. TSTW. TSTW. No matching symbol. They don't have it either. It's not. They say it's out there. Either Crocs made a mistake or it's just not been listed yet. TSTW. No, sorry, we couldn't find it. So we couldn't find it in any of them. So what I want to do now is I want to go look at their websites, so you guys can start looking at their websites. So here's a list of their websites. Again, get your little phones out, take a picture. I've done all this research for you. Might as well let me do the research for you. You guys can go do your additional research, do your own homework. So this is Granite Shares, Round Hill, Curve, Defiance, Axis, Neos, Nicholas. All right. But the one we're most interested, I told him to give me everything but YieldMax, because I was going to assume that we already had YieldMax. YieldMax, so YieldMax isn't in the list, but YieldMax is my favorite. So we're going to go YieldMax, but it's just YieldMax, WIELDMAX ETFs.com. All right, enter, and that's the website. So this is your number one website. This is my favorite. Okay, Granite Shares, Round Hill, those are good ones too. I like those, but this is my favorite. So if you come in here, our ETFs, they've got a list of them. There's all the ETFs. There's all the symbols right there. All right, so you can type all those into your software, pull up all the charts and look at them, but just realize those are buckets of money that are being invested in the underlying stock. You don't expect these stocks, these funds, you don't expect them to go up. You want them to just go sideways. If they're going down too much, that's a little nerve-wracking. You got to be careful with that. You just want them to go sideways. Most of them don't have a lot of history. All right, most of them don't have a lot of history because they're brand new. About 2-3 years is about as long as you can get on some of the longest ones. So that's your that's your list of stocks right there. Those are the ones we're going to be putting our buckets of money in. Now on Wednesday and on Friday, class at the university. And then, of course, we've got our lab here on Thursday. We're going to be talking about how to build a portfolio, how to pick the ones we want, put them together, and build a portfolio that's got a little bit of structure to it, okay? Because you don't want to just kind of shoot from the hip. You want to do it structured, and you want to do it with math. You want to do it wisely. So we're going to learn how to do that on Wednesday and on Friday. But there's your list of buckets that you can put your money in that they will invest for you on your behalf and trade options to get those high returns. And then every week you'll get your paycheck every Friday. All right. Every Friday you're going to get a little paycheck. And I say little, but it's depending on, dollar wise versus percent wise. It's a big number. All right. There you go, guys. Does anybody have any questions before we call it quits for the day? Okay, I guess we'll let you go. All right, I got something for you. You guys, I really want you to pick up Pitt News Magazine. It's the way we communicate after classes are over. So I'm going to let you see this real quick here. Pitt News Magazine is right. Where is it? Right here.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com. Pitt News Magazine. News your way.
And we just barely dropped the most recent version. It came out yesterday. So if you go sign up today, you'll get yesterday's version, and you'll get the next month. You'll get today's and next month's for $1. And then after that, if you keep it, if you don't cancel, it's $39 for a whole year. All right, of Pitt News Magazine. And that's how you join the club. That's how you join the Land Turner Club and be a part of what we're doing here. All right, guys, that's all I got for you. We will see you tomorrow evening in class. Come ready to start putting together a portfolio. We're going to build a portfolio tomorrow. All right. So we'll see you then. Take care. Have a good evening. Have a good day. Have a good day.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.